Well, and this morning we have an update coming in from ICICI Securities. They've upgraded the stock to buy. They've raised the target price by about 20% as well, from about 1,050 to 1,260 odd rupees. Why is that? Because a conversation that they had with the company's CFO Asif Malbari suggested that the company has fast-growing categories which have double-digit volume growth potential itself, and they are driving their underlying volume growth by entering categories that need development initiatives itself. And not just that, it's visible in the way they've gained market share in the soaps business as well, and the integration of Park Avenue brands that they've acquired from Raymond itself. That's largely completed, so that should aid their business too. That's about the India part. Indonesia growth trajectory is also likely to improve, and their target out there is to improve volumes beyond the Indonesian GDP growth and see margins back to about 25% in Indonesia.
Has gone with that commentary on Godrej. Magdam, thank you very much. We've got a 62-point gain to start things off. 21,500 is here on the index. Let's look at the leaders. Tata Motors is right on top, % higher. ONGC starts out positive. Actually, let me check out some of the other oil and gas names as well, the sector that we've just been discussing. BPCL, IOCL, for the time being, small gains on a couple of these oil marketing companies as well. Let's pull up Oil India. Yes, a gain of about 1% over there. So higher oil prices in general, spelling some early gains for some of the energy players. Then you've got the index heavyweights chipping in. SBI, Infosys, L&T. Quite a few of these names are on the upside as the day opens up. On the flip side, Wipro, a little bit of red, not too much, just about a rupee down. But this court case definitely hitting the headlines. Okay, now it's turned positive now. Very flat on Wipro. Actually, there are hardly any stocks declining. Hero Moto is down less than 0.5%, and that's about it. It's a very green-looking screen, and the Nifty is soaring now, 84 points higher, 21,526. LTI, Mindtree, Infosys. So in general, some rebound on the IT space. That's how it's looking like. So early start and looking very strong, guys. 90 points up straight away.
And now we're just about 65 points away from our all-time high level of 21,593. So getting closer to that. In terms of the big, mid-cap action, Kansai Nerolac, which has sold its land in Lower Parel to a real estate company, is up 6.5%. The value of the land or the sale price is 726 rupees. That's a stock which is gaining. Protean eGov. There was this initiating coverage by Equirus, its recent listing, a play on India's digital infrastructure. The issue price was 792. The target price set by Equirus on Protean eGov is 1,500, and the stock is currently at 1240. There is news, positive news on SJVN, India Glycol. Tejas Networks is another one where we've got an initiating coverage, and this time by MK. And that stock is moving up in trade. Zydus Life is one of the few stocks in the red today, and that's on the back of the tax demand which has been hit on the company. Castrol has retreated after the big move that we had yesterday. A couple of the other notable gainers include Vishnu Prakash. There is some news flow there, 8.5%, fresh 52-week high. And gains continue on PSUs, whether it's Nagarjuna Fertilizer, SJVN, GMDC, and South Indian Bank. A board meeting scheduled today where they will be considering some fundraising. That's got the stock excited.
75 points in the green is what we have. So it's a solid opening. This is in line with what the GIFT Nifty was indicating in the morning. So we got 21,500 back on the board on the Nifty. The all-time high, of course, which was made last Wednesday, 20th of December, was 21,593. So we're almost there, about 70, 80 points away. Now, just a few other names. Vishnu Prakash, right? It's a small company. We don't talk about it, at least not in the first hour. I don't recall mentioning it, but it's the second largest volume-led gainer in the market right now on the NSE. That almost 900 crore order from the Uttarakhand government. I think we mentioned that in the morning. Look at the volume, 3 million shares on that name. So that's a big one. SAIL has come up as with a 2.5% gainer as the top volume-led gainer across the board. 116 on SAIL. I think we mentioned SJVN, which is up 3.5%. Neyveli Lignite, that is NLC India, saw a very large move. Actually, last, I think Thursday, stock was at $200. It's 260. So this is in what, 4 sessions, 3.5 sessions from 200 to 260 on NLC India. We, by the way, had the management right before that move started with us here. Ambuja Cements is up about 3%. Nimish was telling us about that Nomura call on cement stocks, and we'll revisit that a little later. GMDC is another one which with a 3% gain, looking strong. Adani Energy Solutions is up about 2%. Adani Green, of course, with that news yesterday, went up 4.5% by close. Yesterday. So these amine companies, Alkyl Amine, Balaji Amine, they were up 5-6% yesterday, and they're starting higher. Alkyl is up 2%, so watch out for Balaji as well as we get into the next few minutes and hours. Amber is up about 3%, and South Indian Bank is another one which is up about 4-5% as well. So out of the gates, coming up with not bad volumes at all for this time of the year, last week of the year. So this is looking good. Vedanta is down about 3.5%, and it's selling off on some large volume. Second largest volume-led loser across the board. Stocks at about 252, 253 right now, and you've got PC Jewelers, which sold off 10%. It's down another 4% right now, and there is KPI Green, which is down about 5% as well at 1,265 at this stage. So that's the overall picture with the market open 80 points. In the green. Atul Suri is now joining us. He's a market master of the day, CEO at Marathon Trends PMS. He's with us here in our studios. Atul, great to have you with us here.
Thanks.
Season's greetings, and I'm surprised you're not globe-trotting somewhere at some
Trekking
fancy
away or
destination.
holidaying at a...
With us.
Too much traffic everywhere. I mean, whether it's the hills of Manali or it's Goa or it's Bandra.
Even in the air, right?
There's too much traffic. I think this is a week it's best to be at home. In fact, I dread to even go around my house because over the weekend I had to just go to a friend's house in the same suburb.
Yeah.
And it took me 1.5 hours to get back home. So you can imagine.
Zoom, I think Zoom celebrations, that's what you have to do in the last
Lata
week.
was Lata's in Goa, and she was telling us yesterday at she was at the Goa airport. Absolute madness and chaos.
Absolutely.
With flights.
So you need a holiday after a holiday like this.
But, and maybe that explains the excitement in the market, because people like you, and I'm sure there are others, who have not chosen to stay away. The screen's been looking exceedingly good. And Atul, I remember all our conversations, Diwali and even before that, you made the point that this is looking like a strong trend and there's no reason to get away from that. And it's playing out absolutely as per that script. What next? 2024.
Yeah, I mean, so what next is the question. Every prediction you make on the market has 3 stages. The first is laughter, second is acceptance, and third is what next. So last year when I predicted a bull market in 21,500 or whatever, immediately the market fell 1,000 points. The whole Adani thing happened, 17.5 to 16.5. And everyone were laughing at me. So when a lot of people laugh at you, you feel very good because there's disbelief. Then it crossed 19,000 and then it was acceptance. And now the question is, what next?
If you don't accept it, there's a 4th stage. It's called grief.
So when people say, what next, you shouldn't give targets.
Okay, no targets, but let me make it qualitative. Let me sort of, in the sense of how do you approach it? And it's the same sectors that you've been speaking about, right? That whole capital goods space, PSU space. The same narrative continues, and therefore it's causing maybe a sense of disbelief to an extent.
Yeah, so I think that the mindset is of most people is that, things have gone up. So they are like skeptical, oh, it's already gone up too much. Now, when I look at global markets, etc., what I think is that the global bull run in equities is just starting. If you start seeing, especially I think, look at the US, etc., you'll find that these markets are just now pushing towards lifetime highs. And if you take a step back and you realize that what is the genesis of all these things that drives, as I said, this is the mothership, is where US 10-year bond yields are. We had almost pipped 5, and you'll find that today we are just below 4. So I feel that bond yields are heading lower to around 3.3, and this whole global narrative of inflation will cool off. So to say, what was the perfect Goldilocks scenario where inflation would cool off and growth wouldn't, get thrown into a recession basket. I do think that the year is going to be dominated by global markets. So when I see whether it's S&P or it's the Dow Jones Industrial or the NASDAQ, I see almost an 18 to 20% upside from here.
Wow, and that's after such a strong year already. Talk about...
So actually, Surbhi, they haven't had a very good year last year. I mean, for them, it's been a year of fall and recovery. So that's why I said the bull market is actually starting there. And I feel that that is going to be very, very positive because for India, obviously, we've been probably the first market to break out to lifetime highs. In fact, very few markets are still at lifetime highs, but India is the first to break out. So I think in a scenario where global markets, I feel, have a 18 to 20% upside, I don't think that India is going to lag in a big way. The question is, will we relatively underperform, outperform? Have we front-ended it? Have we already run up in I think these are questions that we will, I think, have to struggle with during the year. But I do think that we are heading into a year which is going to see a very good upside in global markets. And what's going to change in India is that last year was all domestic, which is your domestic flows, SIP flows. Already December is showing it. But I feel that this year, the coming year, will be the largest FII flows the country has ever seen. So what we are going to have is, of course, the domestic money, which is steady and through SIPs coming. And you will see a very large flow of FII money. I mean, they have sold at 17, 18. Not that they did not like India. I mean, they also are smart guys. But it's the way they are structured, the bond yields, cost of capital. They have various permutation combinations. And as bond yields are going down, I won't be surprised if you see a tsunami of FII flows in India.
Atul's answer is reminding me of a Bollywood song. Abhi to party shuru hui hai.
No, I mean, absolutely. Actually, in the US, for example, Atul, if you take we talk about S&P and NASDAQ having done 30% this year, it's the 7 stocks. If you, with the AI stocks, the AI frenzy which started.
Yeah, the Super 7.
So, it's interestingly, if you look at the equal weighted index, it is actually the S&P or the NASDAQ, it is actually flat. It may have gone up a few percentage points now, 3-4%.
It's
not 30%, it's 3-4%.
That's right.
But the index is what it is. I mean, it's just that 7 stocks have an outsized impact.
I think that's very relevant. And for me, what I feel is the most interesting thing is that actually the opportunity that's happening. Like I am looking at something like the Russell 2000, which is the small cap index, which if you look at it is not near 52-week highs, but nearer to 52-week lows.
Yeah.
But the way, if the front end of the market does it, I have a feeling that there's going to be a very big alpha that is going to be created in that space. And if you look at the US, I mean, just to, take off from where you look, if you do an analysis that comes to sectors and themes, because beyond markets, that's the next question. The fact is that the S&P 500 is just about 1% or so from lifetime highs. The NASDAQ is a fair bit away, 7 to 8%. But the Dow Jones Industrial has made a lifetime high. And it is a good few percent higher than that. So what I'm seeing is that not only is a bull market that I feel will happen globally and especially in the US, but what I think is that industrials will lead it. So yes, the Super 7 are doing well, that's driving the S&P, etc. But I have a feeling that if you look beyond that, a lot of industrial stocks, a lot of the old economy stocks are actually also at lifetime highs. And I think that the year is going to belong to the old economy. It's going to, be dominated by the industrials rather than just the Fab 7.
From the virtual to the physical.
Absolutely. Yeah, and I guess, there are things, alteration is a reality of life here. In our markets, what is not done well for 10 years, very often.
Absolutely.
Look at PSUs. Yeah. I mean, every guy had sworn. It was like almost, it was a written charter that we will not buy PSUs because people have burned their fingers over 10, 20 years. And if you look at the last year and this year, it's been the most stellar pocket that there is. So very often markets have a way of alternating, and where everyone is consensus bullishness actually disappoints, and where under ownership is there, that is what does well. So I have a feeling that even the US, that sort of upside is going to be led by industrials. And for my bet would be in the Dow Jones Industrials or the Russell 2000 rather than the NASDAQ.
Let's talk about back home. Right? In India, also industrials, PSUs have done well. And the narrative was there is an improvement in fundamentals, plus there is value. Valuations are fairly reasonable. But now the question is, will the fundamentals keep improving to the extent of re-rating that we should have in a bull market? If the stocks have to double, triple from here on, you need to see a tangible, a material improvement in fundamentals.
Sure.
Can that take place? Can the fundamentals move in step with the valuation re-rating for a bull market?
See, honestly, that only time will tell in terms of execution. But if you look at two sectors, which I look at it, defense, if you see the kind of order flows, there's been a lot of talk of indigenous defense work, but generally the order flows are coming. Now, how execution happens is a work in progress, and that we'll get a sense over time. But if you see the size of opportunity and the kind of order flows that are happening, I think it's massive. Second area, which I find very fascinating, and we don't have a sector per se, is railways. If you see the kind of work that is happening in railways, I think it's phenomenal. And for that, you must actually travel intercity by train. And you'll realize that it's actually better than flying an aircraft. If you fly some of the Tejas or, the Vande Bharat trains, etc. So there is a qualitative shift that has happened in railways. So what we are seeing is that not only is the size of opportunity big, I think the execution is improving, and then obviously the valuations were very, very cheap. So I feel that that's been a phenomenal story. The only thing is that it teaches you never say never in this market, because what people thought they will never ever touch has actually been the best performer.
Yeah.
So, and I take your railway point entirely. It took me 7 hours to come from Delhi to Bombay.
Right.
About 7 to 8 hours. So I
Right.
think trains are probably going to be a better mode of
Especially
transport.
if you're doing
soon enough.
shorter distance, like you're doing some place in Gujarat or in Maharashtra,
Yeah.
with flying time, the amount of check-in time and the mess. And I mean,
Exactly.
like,
The waiting and
yeah,
the
yeah. I mean,
lines.
and the
Places like
experience.
Surat, etc. are case in point. I mean, very
Yeah.
convenient.
Yeah, I think the experience itself is far superior to flying in a plane, actually.
Yeah, absolutely. Experience where you're holding the railway stocks or traveling in the train.
sure.
I think the experience has improved.
Definitely.
But, so, Atul, I think the question for 24 is that if the same themes will continue, and 23 gave us these themes, PSUs, defense, industrials, I
Right.
think people feel a sense of complacency, saying, oh God, I'm not looking at a new idea. Am I missing something? Should I be looking at EVs? Should I go back to FMCG because FMCG is underperformed this year? You know, the human mind tends to constantly look to do more. Otherwise, you're
Absolutely.
feeling you're not doing enough to
Certainly.
earn your money, right?
Absolutely.
So what do you say to that conundrum that I think many would be facing as we step into the new year?
See, I'm a trend follower. That's my style of investing. And as the line goes, the trend is your friend until the end when it bends. So the fact is that if the trend is playing out, the need to do something all the time, compulsive action. See, in a bull market like this, someday sector A will move, sometimes sector B will move. But at the end of the day, you can't be churning your portfolio every week or every month. The important thing is for you to realize that what are the larger themes and trends. And you will have some weeks of underperformance, some week of outperformance. But I have noticed that in the end of the journey, however long it is, no one knows the ending. But the important part is that if you've got sectors and themes which show leadership and you have conviction, it's best to hold on to it. The need for activity is something which is more your own limitations. But even sitting, I have seen that the biggest wealth creation, as they always say, is in sitting. So if you've got themes which you believe in, I believe industrials is the theme that is going to lead. I would sit through it patiently.
So sit back and enjoy the ride.
Absolutely. Atul, thank you so much for coming down to our studio.
Thanks for having
Great
me.
chat as always. Season's readings and all the best to you.
Thank you very much. Thanks, guys.
Thank you very
Bye-bye.
much. Well, we're going to talk about one theme now where I think there's been a fair bit of excitement. It's a sector which has not done very well if you take, say, the last 3-4 years, although I think the fortunes looked like they were starting to change a little bit. For a bit, there was a flicker of hope. Life insurance is what I'm talking about. So much regulatory, change which has been proposed. Some of it has happened. The latest, of course, is what the IRDAI, the regulator, is proposing in terms of surrender charges, which insurance companies are allowed to charge their policy holders. Now, this is a proposal. It's a consultation paper. Sources tell CNBC-TV18, and we put the story out yesterday, that in response to the consultation paper, insurers want IRDAI to extend the time by which they can submit the feedback on the proposals till the 31st of Jan. The earlier date was 3rd of January. Yash is here with the latest, but also a bit of context in terms of why this issue is important, and then we'll get into a discussion with some experts. Yash, take it away.
Well, Prashant, the last 2 weeks we've been discussing everything, right, in terms of how the higher surrender value proposed by the regulator will be calculated. And of course, the sum and substance is that this particular proposal is beneficial for policyholders since it gets them a higher surrender value when a policy is terminated on a voluntary basis. But it's negative for life insurance companies because they get to retain, far less in terms of the surrender charges which they charge to these policyholders surrendering their policy. The difference is significant, and I'll just give you two numbers to help you understand what kind of significant difference does it make. Policyholders are expected to get 50% higher in terms of surrender value to what they receive now, and life insurance companies will get to retain just 1/3 of what they retain currently in terms of surrender charges. Now, since the last 2 weeks, there have been various developments on this one. There are concerns raised by life insurance companies. They've written to the IRDAI chairman to seek a meeting to express those concerns. But largely, the concerns are that this will lead to an asset liability mismatch because the pricing happens in a certain way. Also, they feel that this will bring a drop in the industry persistency levels. As far as some of the suggestions which life insurance companies want to put forth as far as the regulator is concerned, concerned, life insurance companies are saying that they feel that higher surrender value should be given on short-term policies and not on long-term policies, because short-term are closer to maturity by the time they surrender. Same is not the case with long-term. Also, they seek the threshold limit to be a percentage of the premium, charged to the policyholder and what they've received. IRDAI, according to our sources, is not in favor of giving them that threshold limit as the percentage of the premium paid. Rather, the regulator feels that it should be the expenses which the life insurance company has made on a particular policy, plus some bit of nominal charges. That is the threshold which IRDAI sees. The same is not the case with life insurance companies.
All right, Yash, thank you very much for that. Well, let's take this discussion forward. We have, an expert in the field, the subject of personal finance, actually, the author of a book which needs little by way of introduction. Let's Talk Money. Monica Allen is joining us now. Monica, good morning. Great to have you with us here. Thanks very much. We have Nilesh Sathe, who's the former member of IRDAI, also with us. Mr. Sathe, thank you very much for joining us from a vacation. Really thankful.
Thank you very much.
Thank you, sir. Monica, if I can start with you. I mean, how do you look at it? You heard Yash explain. We've been on top of the story, since this was first put out. Is this going to be disruptive? Is it going to get diluted as you see it? What's your sense? Great for consumers, of course. Policyholders, of course, if it goes through as what the regulator is proposing.
Right. So I want to put it in context. How would you react if a fixed deposit, a 5-year fixed deposit, if you exited after 1 year, gave you nothing back? You've put 1 lakh in a fixed deposit and for 5 years, but you exit after a year and you get 0 back. And after 3 years, you get 1/3 back, right? So life insurance policies on the traditional side are akin to deposits with a life cover attached to it. I have not for decades been able to understand why investor gouging happens when policyholders surrender too early. So if a person puts in 1 lakh and doesn't pay the second premium, today she loses all her money. After 5 premiums, if she doesn't pay the 6th premium, she gets out of 5 lakh only 2.5 lakh back. Right? So this is what I call the product is constructed like a trap with very high first-year commissions. IRDA has now allowed insurance companies to fix their commission levels. Sometimes it can go as high as 100%. So the first year entire premium is going as commission, and then the commissions are dropping to 7.5% in subsequent years. So the agents hard sell this product, and then because the companies make profits out of surrender values, investors are almost nudged and encouraged to surrender their policies early. You must know that the persistency is 44% today on the 5th year persistency, which means more than half the policyholders, less than half the policyholders take home half their money after 5 years, right? So you're getting less than half your money for more than half of the people who hold the policy. So the product is built like a trap. I am not sure why IRDA is treating the industry with such kid gloves. It needs to write a regulation. It can't say, here, I'm opening the locker door and you can decide whether you want to stay or go. So allowing the industry to fix their own surrender values is very surprising to me, that the regulator, when it's trying to solve this problem of investor gouging, is allowing the industry to do that. So that's my short point, that, IRDA, write a regulation. Why are you afraid of the industry? Are you an industry association or are you a regulator?
No, but they, to be fair, Monica, they are trying to correct it, aren't they? They're doing something about it now.
But they're saying, okay, here is a way ahead. You decide how much you want to give back. Now, which company, when you're booking profits on this horrible surrender value profits, remember, it's the blood, sweat, and tears of policyholders which are being booked as profits on early surrender. Which insurance company is going to be fair? I mean, it's not an industry which has covered itself in glory on investor interest. So you are handing the baton to them.
Yeah. No, I get that, and absolutely points taken. Mr. Sathe is also with us, someone who's been on the policy-making side. Mr. Sathe, you heard Monica What's your first thoughts, sir, on the subject?
See, the first is there is a difference between a bank fixed deposit or a mutual fund and insurance. In case of insurance, it's a group of people who get insured, and out of that, certain percentage of people do die in the first year or the first day of taking the policy as well. And for them, the amount of money that is to be paid back by the insurance companies is much more than the premium which is paid by them. Where from insurance companies will generate this money? They will take this money out of the lucky ones who are surviving over a period of time. So in the first year, this mortality premium, which is in case of traditional plans, which is being prescribed, actually that is certainly on the mortality amount which is going out of the premium that is paid by the surviving ones will have to be recovered by the insurance companies. This is not like a fixed deposit. This is a basic difference. This is one part. I'm not here to, only talk about the regulator or the policy or the insurance companies. Understanding the rationale between it. We have seen that insurance is a long-term product. It is not a 5-year fixed deposit. Even in case of mutual funds, we have seen that the SIPs lapse after 3 years, most of the SIPs. And insurance being a long-term product, it is necessary that policy should continue for a long term. And for that, this is one of the arresting measure that the policy should continue for a longer period of time. This is one part. As far as profitability is concerned, over a period of time, IRDA has been looking at how surrender values can be increased. They have done it. In the past, LIC only used to give 30% of the premiums paid other than the first year as surrender value on 3 years completion. It has been now increased substantially. As Monica also has said, it comes to 50% at the end of 5 years plus bonus, which she has not taken into account. 35% of bonus will also be added to it. Anyway, that apart, what I mean to say is, one, whether IRDA should look into it, I say yes. Policyholders must keep on getting higher amounts as IRDA should prescribe it. If at all IRDA finds that this is adding to the profits of the company, IRDA should restrict it. But in the process, insurance companies should not be made to incur losses. This is one part which again the regulator also has to see. So this is one more point which I wanted to bring about, that let us not keep comparing the products, whether it is fixed deposit or a mutual fund or insurance companies or all financial products, and whosoever wants to invest in that product should invest. Whether insurance should be looked as investment avenue, answer is no. Why is it that people are investing in non-profit or participating policies? They should not invest. This is something which we should promote. Insurance is a unique product which gives huge amount of money on death, which no other investment avenue gives. So it should be invested only for that purpose. So this is something which should be promoted, and I personally feel that the step of IRDA is indirectly in this direction, that why do you invest in with profit policies or with bonus policies when insurance should be taken only for the purpose of coverage of risk on life. And if this is understood, you are getting less surrender value, okay, fine, so don't invest. You have
Mr.
to look at
Sathe,
insurance only from insurance point of view. Do that. And that is something which everybody of us should keep promoting.
absolutely, Mr. Sathe, we couldn't agree more with you. And I think a lot of the pure play financial, planners, educators, people like Monica, a lot of the experts we call on the channel as well. I mean, I have never met anybody who says, look at investments through insurance. Each one of our guests always says that, cover yourself with pure term insurance and look at investments separately. But then, that's a much bigger conversation for another day. The point is that maybe it's not intentional. The products are not designed to generate more profit, but perhaps, even there are unintended consequences. And what's happening, as Monica said, with the commission structure, if you have commissions so high in the first year, the mutual fund industry, for instance, moved to the trail commission model, right, where commissions are paid out for investors continuing to be in the product. Perhaps along with higher surrender value charges, is there a need to look at maybe the commission structure? I mean, how can we ensure that investors do manage to surrender the policies that they don't like anymore or don't find useful anymore, and get an adequate amount of money back?
Yeah, if you are asking this question to me, let me reply. One is, no 100% commission is paid by anybody on any product. The first year entire amount goes for commission is absolutely a myth. This is one part. The initial expenses are high. Stamp duty is to be paid. Whether bank fixed deposit pays stamp duty or whether mutual fund pays such a high stamp duty on insurance policy is at 20 paisa per 1,000 sum assured, which is atrocious. GST at 18% is atrocious. Of course, GST doesn't come in picture at this point of time, but this is something which we should talk about, leaving it apart. The mutual fund product gives you commission based on the NAV. NAV keeps on going up, but in case of insurance product, which is a ULIP product, it is a fixed amount of commission that is paid because it is based on premium, and the premium doesn't go up. So there is a variation. See, what I mean is every product is different. If all products are identical, then why is it that people will take different products? Every product has a different flair. So those who like it will buy it.
I think you make your point, strongly, Mr. Sathe. Let me give an opportunity to Monica to come in as well and to respond to some of what you said. Monica, go on.
Look, when Mr. Sathe is saying that a person buys a policy and he dies next year, where is the money going to come from? Now, I'm really surprised being member of Member Life IRDA, he's making such a basic error. The whole mortality premium is designed by actuaries for exactly that point. So there is two parts of the insurance premium. There's a mortality part and there's an investment part. The investment part is 90% of the entire premium. The mortality part is less than 10%. And that mortality part is aimed to take care of deaths midway through the policy. So I just don't understand this argument that, oh, the people have to be paid, therefore there have to be high surrender values. You know, that's insurance 101, and I'm very surprised to hear that. Second is that here when you're comparing a product, you have to see its function and not its form. What is the function of a traditional insurance policy? What are the products they buy? They buy basically government bonds. So what does an insurance policy do? It buys an 8% government bond and it gives the investor 2 to 3%. So this is one, in its essence, it's value destruction. Two, you are penalizing a policyholder who has been hounded by an agent, who's been lied to by the banking relationship manager to buy this product, which they say is a very high return product. And if you realize your mistake any time after the first premium, you suffer huge losses. So my point remains that it's built like a trap. And just the fact that the insurance companies listed on the market are suffering losses just on a draft which is consultative, which points in the direction of investors getting a fairer deal. If insurance companies' stock prices are falling, I mean, what other evidence do you need that these profits are built on the tears of policyholders who have just had their money gouged out? You know, I feel very passionately about this because not many people understand the technicals of insurance. When you understand it, you are aghast at the open robbing of policyholder that has been going on in the country for decades. So that's my short point, that this is an industry built on the blood and tears of policyholders, and it shows up in the profits of insurance companies, which are now suffering because IRDA has dared to put out a very mild draft. That's my short point.
We take this point, and I reckon this will require a slightly longer chat than the 15 minutes we've spent on the subject. But, we leave it here for now. Thank you very much, Monica, for passionately making your case. Mrs. Sathe, for strongly putting forward your point as well. We'll have both of you back and others as well to continue to debate and discuss this important issue in the insurance space. Thank you very much. And Mrs. Sathe, please do enjoy the remainder of your holidays. And thank you for joining us. Thank you. We'll take a very quick commercial break here. Markets up 100 points in the Nifty. We are back with the management of Max Estates. That's a pure play real estate sort of company out of NCR, Delhi NCR. And we'll talk about the business outlook. Stocks done very well. We're connecting with them in just a bit from now. And after that, we'll talk about the Red Sea Suez canal issue. And we'll have that discussion going with the Container Shipping Lines Association's Sunil Vaswani, who will be with us. Stay with us.
CNBC-TV18, embarking on a quarter century of excellence. CNBC-TV18, embarking on a quarter century of excellence.
Welcome back. We've got the market on a bit of a tear, roaring away, and the gain is almost a full 100 points on the Nifty, 109 actually, and the clock is still ticking, 21,550. Very, very strong opening that we have for us. Let's quickly move on and talk about the next company which is on our radar, and we're looking at Max Estates now. The stock listed on the 30th of October this year. Since then, it has moved higher by about 16%. The company launched its first residential project in Noida. Its pre-launch sales clocked about 1,800 crore rupees. Rishi Raj, Chief Operating Officer at Max Estates, is with us to talk about the plans going ahead, business outlook. Rishi, thanks for joining in. Season's greetings to you. Hope it's not too cold out there in Delhi NCR. But, let's start with the basics.
Nice to be here.
Lovely. Well, let's start with the basics. Tell us more about this first project, the Noida project. I mean, how the take-up has been like. And give us a bit of a near-term outlook. Let's say, if we look at 24, 25, 26, do you plan to primarily remain an NCR, a North India sort of a company? Give us the way you think your mix will shape up over the next 2 to 3 years.
Thank you, Sonia. Thank you. As far as our first project, residential project in Delhi NCR is concerned, in Noida, this is on 10 acres, 1.1 million square foot, one of the least dense project in Delhi NCR, 201 units, and market has responded extremely well. They have responded extremely well to a promise of live well. The design is really focused on ensuring holistic well-being and top-notch consumer experience. So this particular project is not only sold, our first collection is in, and the construction is already begun and is well on track. So that's about our Noida project. In terms of our outlook and what is in pipeline, as you may know, we have successfully built a portfolio of 8 million square foot, of which 4 to 4.5 is commercial real estate, 3.5 is residential. Of commercial, 1.5 to 2 million is already delivered, and we have established a very successful track record in commercial office space anchored on work well philosophy. First two project, 100% leased. The third project, which got completed in Feb, already 50% leased at 25 to 30% premium. On residential, we are looking forward to launch our second project in Gurgaon mid of next year. This is going to be 2.4 million, right at the start of Dwarka Expressway in Sector 36A. And this is going to be first intergenerational project at scale that Delhi NCR would have seen. So that's what we have in portfolio at this point in time. In terms of beyond 8 million, we are looking forward to acquire almost 1.5 to 2 million square foot of residential opportunities every year to deliver on our guidance of 15% on an average growth in booking value year on year, which, as you rightly said, this year was 1,800 crore on the residential side. We are looking forward to 22 to 2,400 crores next year and take that trajectory of booking value to 4,000, 4,500 crores. And that is the trajectory we would like to maintain.
Okay. Rishi, hi, good morning. Rishi, hi, good morning. Prashant here. Sorry, let me just allow me to come in. So basically, pre-sales of 1,800 crores so far, right, on the residential side.
Yes.
And you're saying that for FY25, that number should be what? Should be 4,000 crores?
No, for FY25, the booking value
FY25, yes. Yeah.
Targeting is 22 to 2,400 crores and then maintain a growth trajectory of 15% on an average. And seeing in a 5-year time, look at the booking value of 4,000 to 4,500 crores in terms of residential booking value.
Okay.
Yeah, and what about the commercial assets there?
So
what the rentals?
Just one more thing, Rishi. You said you plan to add how much? 1.5 million to 2 million square feet annually. Is that the number?
Yes.
Residential?
So for us to deliver on this trajectory for residential booking value, we aspire to add 1.5 to 2 million square foot of gross development value through joint development or outright acquisitions in Delhi NCR every year.
Will you have to take on a lot? I mean, how will you fund this annually? Could you run us through your sort of on the debt side? What will numbers look like as you do this?
See, I think broad guidance in terms of funding, it will come through multiple sources. As I said, 8 million square foot is already in. Of that, 4.5 million is commercial. Commercial has got top line annuity potential of 450 crore at peak occupancy. So the sources of funding will be multiple. On the commercial side, we have got New York Life as a joint venture partner. And we will be using the LRD against those rental income as one of the sources. The internal accruals from existing residential project would be another source that would be used for funding. And we would also be looking for we will be using joint development routes, preferably in the residential growth, to keep it from a capital perspective, relatively asset light.
Okay, Rishi, before I go back to the numbers on the Noida project, just to get the debt picture out of the way. So what is the debt equity? I mean, the debt that you are comfortable taking on as you fund a lot of this expansion?
So if you look at our current debt to equity, its net debt to equity today, as of first half 2020 FY24, is 0.4. In terms of our guidance for debt to equity, we would like to maintain it below 1, on an average 0.7 to 0.8 debt to equity ratio. And as a matter of principle, we would not like to acquire land through debt. That will mostly be equity funded, and construction finance, as and when needed, will be through debt.
Okay, got that. Now I'm going back to the bigger number of 4,500 crores. That's the residential booking value number that you've given. That should play out from the Noida project by what, say, FY26?
No, so see, Noida, okay, let's distinguish between accounting top line and booking value. If you're talking about revenue, which in real estate get accounted for on possession, then the Noida project, which we have already booked 1,800, which will be collected over 4 years. Once in next 4 year Noida project is delivered to customer, it will be accounted as revenue in the top line in 4 years from now. What I'm talking about is every year, when I say booking value, what I mean is what is the value that we are expected to book through residential launches every year.
Yeah, got that.
Okay, beyond.
Let me just ask you about commercial on the two things, the Max Square, Phase 1 and Max House. What is the progress in terms of sale, lease, etc.? Where are you at?
Okay, so just to recap for your audience, Prashant, Max Towers and Max House Phase 1 was our first 2 commercial office project in Delhi NCR. Both of them is 100% leased, 30% premium. Max House Phase 2, which is 1.5 lakh square foot, that we have got occupancy certificate in December, and I'm really happy to share that we already pre-leased before occupancy 54% of the total, and we expect it to lease completely over next 6 to 12 months. And that is again going to be at significant premium to micro market. As far as Max Square is concerned, which we got completion in February of 2023, which we delivered in a record time of 3 years from February 20 to February 2023. That since completion, we have already leased 50%, and we have a very solid pipeline and looking forward to completely lease that over next 12 months or so. And again, we are able to command premium in the similar range even for Max Square Phase 1.
Got it. Rishi, we'll leave it there. It's a pleasure having you with us here on CNBC-TV18. Thank you very much for your time. Season's greetings from all of us here, and all the best of luck as we head into 2024. Thank you very much. That's Max Estates. There are new listings on your screen as well. There is Happy Forgings and Credo Brands. So Credo Brands lists at a slight discount, 1.5% lower. Happy Forgings, though, is up 15%. So that's a big pop right at the word go on day one. 974 on Happy Forgings, and Credo Brands now at about 278. So, it's a... I can see some familiar faces with bankers, etc. there. And of course, you'll hear from both the managements on the channel a little later during the day talking about the business. And I think now post-listing, they'll be able to share some financial guidance, etc. as well. So, a spate of listings. I think we had 3 yesterday, we've 2 today, and I think it goes on. So very, very strong IPO market, primary market. Very well received IPOs as well, mostly doing very well.
Tomorrow we've got Azad Engineering, and then on Friday we've got Innova CapTab, which will be listing. So 2 more on the anvil this week. Now Credo Brands is back in the green. It opened lower, it opened with a cut, but now has managed to, it opened flat, it dipped a bit, but now is back in the green, while Happy Forging continues to have a fairly decent listing. Let's get to Mitesh once again. It's 10 o'clock, so it's time to revisit the market technicals and get in a few calls too. Mitesh, 100 points plus now on the Nifty, 4th consecutive day of gains now for the benchmark indices, and it's green across the board. It's a uniform day of green across the indices. What have you made of the morning, and what would your calls be?
So the morning is quite good, as you were highlighting. It's green, and the Nifty is also now on the verge of getting past 21,550, which for me is an important pivot. I think once that happens, then I think we can look at targets of around 21,700, 750 to begin with, and good chance of 21,950, 22,000 being tested as well. So stay long, trade with positive bias. The stocks that I have on my recommendation list is L&T. It's making a fresh swing high, so buy here with a stop below 3,500. Look for a target of around 3,600 as the first level to watch. And the other one is Bharti Airtel, which I would recommend buying with a stop just below 997 for targets of 1,035.
Okay. All right, Mitesh, thank you very much for the trades. We'll come back to you a little later to see how things go along. Well, let's now put the spotlight on the recent attacks on ships passing through the Red Sea trade route, which has, of course, raised a lot of concern in the entire shipping fraternity. 2 India-linked merchant ships were caught in drone attacks yesterday. The Indian Navy has now deployed 3 warships in the Arabian Sea, looking at the situation. And obviously, this has raised plenty of concern among traders, exporters, importers. We have Sunil K. Vaswani, Executive Director at Container Shipping Lines Association of India, joining in for a quick chat. Mr. Vaswani, thank you for the call. So we do understand that there is a concerted effort underway. There's a coalition of major international countries as well to try and monitor, and more military presence now along the entire Red Sea route leading up to the Suez. How are Indian shipping lines looking at it? Is there any fresh requests being made by the government for greater monitoring? I mean, what exactly is the state of play?
Well, morning, and first of all, season's greetings to you and to our viewers. Let's hope that the new year brings in some good news for all of us.
Thank you.
Yeah, it's indeed a matter of concern. So let me start off. As far as the container shipping lines are concerned, we during the COVID, we did all we could to help the supply chains. We put in additional capacities and started new services, and then we were all on absolutely even keel, everything working out well, and then suddenly this thing had to happen. So another challenge that's come up, it's certainly a matter of concern. But what's encouraging is that the US-led initiative, Operation Prosperity Guardian, and the Indian, the efforts by the Indian government as well to ensure maritime security are indeed encouraging. In the meantime, of course, we were forced because some of our own ships also were attacked, and the container shipping lines, some of them were forced to divert some of their services from Red Sea and Suez Canal to over the Cape of Good Hope. And obviously, this did increase the cost, increase the transit time by about 10 days, and increase the cost because obviously the cost of additional transit, that increases the charter hire per day, also the insurance cost. Then we had to put in additional capacities. For instance, if you have I'll just give a quick example. If you're operating a service between India and Europe, the round trip takes about 56 days for 8 ships. And if you're going, and that's if you're going, taking the shortest route via the Suez. But if you're going over the Cape of Good Hope and adding another 10 days, then you need to put in one additional ship. So that additional capacity has to be introduced, which also increases the cost because additional ships are to be put in. And of course, when the demand goes up for ships, the charter hire goes up, and also the charter hire per day goes up because of the additional transit. So be that as it may, that's what it is. But because of the encouraging news that we've had lately, as far as maritime security is concerned and Operation Prosperity Guardian is concerned, one of our lines, Maersk line, for instance, has announced that they will revert to the original schedule of going over the Suez Canal.
Suez, that's right, that's right. So, can we get some tentative indication of charter rates? I mean, since this whole issue flared up, it's been about, I think, what, 2 weeks now. What is the increase in immediate spot rates, if any? If you could give us some sense of the market right now?
See, it's very difficult to say that because charter rates depend on the size of the ships. And each of the lines have different size of vessels. But I can tell you very roughly, on an average, I can tell you about $60,000 a day is a charter rate. But what could happen is all these costs could translate into additional costs for the lines, and then eventually, of course, additional costs for the exporters and importers as well. Right now, the shipping lines, although they are going over the Cape of Good Hope and incurring heavy costs, the additional cost to the end customer has not been that significant. I mean, some surcharges that we were forced to put in place to take care of some of the additional costs have been done, but the overall effect has not been very significant. But if this situation turns for the worse and we are forced to continue over the Cape of Good Hope, then cost increases could be quite significant.
Okay. So, Mr. Vaswani, what percentage of the cargo has been diverted now to the Cape of Good Hope? So, say earlier, in 100 units, what percentage has been held back, not able to proceed, has not managed to divert? Just give us a breakup.
Yeah. So, as far as India is concerned, we are more impacted by exports rather than by imports, for the simple reason that most of the imports of India come in from the Far East, as we all know. And some imports basically come in from the West, that is Europe and US. So I would say about as far as roughly about 70% of our imports are concerned, by and large, we are not that impacted. But the reverse holds good for exports, because these exports eventually take place to destinations in Europe and to the US. And for those sectors, of course, we've had to, many of the lines have had to divert over the Cape of Good Hope, and that's why the increased transit and the potential increase in the costs.
Mr. Vaswani, just to go back to the cost point, you said 60,000 USD is, the day rate. And these are tough to generalize, I get that. But to understand the issue, assuming if there is to be this diversion and ships are to be routed around the Cape, Then ballpark and higher insurance costs given the scenario right now. Ballpark for an exporter, what is the increase in freight cost we're talking about? Is it 5%, 10%, 15%? I mean, just rough back of the envelope math so that investors understand, what is the increase in cost of doing business?
Sure. So again, as you very rightly said, this is going to be a very ballpark figure because right now, things are very hazy even for us. But I'm just saying, just in case the situation continues and it continues to get from bad to worse, and we're forced to go through this route and put in all the additional services that are required or the additional capacities, then we could possibly say, for instance, from Nhava Sheva and Mundra to Europe, for instance, the increase could go up by another 80% or so. Also, so the freight costs overall to the ultimate customer could be to that extent.
Oh, wow.
But again, as I said, there's a ballpark figure if the situation turns for the worse and if the situation lasts longer.
Well, let's hope we don't go there. And hopefully, of course, governments across the board, I think, are cognizant of the matter and taking steps to ensure that secure shipping lines are restored through the Suez. Thank you very much for joining in. And once again, season's greetings to you.
And if I can just add on one more line, as far as we shipping lines are concerned, the safety of the cargo of our customers is of primary importance, and the safety of life at sea of our sailors, our staff is very important, and eventually the assets, because that's how we're going to be able to help the trade. And we've done in the past everything that's possible to help the trade, even during COVID and post-COVID, and we shall continue to do so even now. Thank you.
Okay. Thank you very much, Mr. Baswani, for joining in. Let's get to the stocks on the move. Earlier today, our standout brokerage report was on cement. Nimesh had spoken about it. Let's go back to him. Nimesh.
Hi, so the entire cement sector is buzzing in trade today on the back of a large upgrade from Nomura. Across cement names, they've upgraded a few stocks to buy from neutral, and they've raised their target prices as well. So on Ultratech, the new rating is buy from neutral, and there they've raised their target price to 11,500. They've also upgraded Ramco Cements to buy now, and there they have a target price of 1250. And on Dalmia Cement, the new target price is 2,900 versus 2,600 earlier. Even on Shri Cement, they maintain a buy rating, but there they've raised the target price now to 34,400 versus earlier target price of 27,800. Now, why Nomura is bullish on the cement sector? They believe that the upward momentum in terms of pricing and volume is likely to continue. They expect the margins to expand on back of strong volume growth, pricing discipline, as well as relatively lower fuel costs. So the momentum in terms of volume growth is likely to continue in the second half of FY24, and by FY25-26, they expect the volume growth to be higher than the last decade's volume. In terms of pricing as well, they expect the trade prices to improve as the industry exits the pre-election phase. So on back of strong volume growth as well as pricing discipline, they've raised the EPS estimates, target prices as well across all the cement names, and few stocks have now been upgraded to buy from neutral earlier.
All right, Nimesh, thanks very much. Ramco is the top gainer in that space with a 4% pop. Heidelberg is number 2 with a 3.5% gain, and then there is Ultratech, which is up about 3% as well. We'll take a quick commercial break here. Manisha will be here with what's happening in the commodity space. Stay tuned, that's coming up.
CNBC-TV18, embarking on a quarter century of excellence. CNBC-TV18, embarking on a quarter century of excellence.
Welcome back. Let's turn our attention now to the commodity markets. Manisha is here with us. Manisha, what are you tracking?
Well, I'm looking at the iron ore prices, and that clearly has been the best performer within the metal sector. We are looking at prices trading at an 18-month highs. It's been a good year. We started on the lower side, and we are perhaps trading at the highest level at 2023 at this point in time. We are holding around $140 a ton, and it's up by 25% in 2023 till time, with a couple of days more to go. Well, China accounts for 70% of global demand when it comes to iron ore. And while the property sector has not been doing so well, what has been doing well for China and for the rest of the world is strong demand coming in from sectors like shipping, machinery, auto, and even infrastructure. For the Indian markets as well, the steel demand has been on the higher side, and iron ore is the major ingredient into steel, and that has been supportive for this particular metal there. If you look at the global trade then, and that has been increasing on an year-on-year basis as well. 2022 was 1574 million tons. This year is estimated at 1646 million tons, and next year almost 1700 million tons. And it's a similar chart when you look at the Indian iron ore trade numbers as well. It has been growing to the tune of 8 to 10% onto that one as well. I want to come on to prices. An all-time high has been at $223 a ton, which was hit in July 2021. We started this year almost at around $100, and the lowest for 2023 has been at 99.5. So 100 more or less has held, and the high is at 145, and that's exactly what we are trading at right now. For the next year as well, the markets believe that you could be looking at demand picking up, especially from the property sector as well. So not too many bearish calls coming in for iron ore for the next year as well. The most bearish actually is from Fitch Ratings at $95 a ton, but 100 to 120 is the expectation of an average iron ore prices from ANZ, JP Morgan, Fitch, and BMI as well. All of them believe that the iron ore prices will consolidate in the next year too.
Thank you very much for that. Let's get into a break on that note. We'll come back and get to our special offering, the big winners of 2023. Today, we'll chat with the management of RailTel. The company's MD, Sanjay Kumar, will join in next.
CNBC-TV18, embarking on a quarter century of excellence. CNBC-TV18, embarking on a quarter century of excellence.
Welcome back. One of the big winners of 2023 is RailTel. The stock has gained 130% in 2023 so far. And for this year, FY24, the company has guided for a 20 to 25% revenue growth. Sanjay Kumar, the Chairman and Managing Director at RailTel Corporation of India, is with us on the show. Thank you very much for joining in, Mr. Kumar. This is Reema here. There is a lot of excitement about the potential revenues or the opportunities from the entire railway segment. We've had so many comments from the minister saying that the government is planning to invest about 7 lakh crore in the upgradation or new lines for railways. There is, Kavach, which is the protection system that you use for railways, which will be deployed on new lines, even the existing ones. Can you tell us the opportunity for, RailTel and also the game plan from the government?
Yeah, so thank you very much, Reema, for inviting me. Certainly, investors are posing a lot of trust and they are looking at a lot of potential in our company. We are also equally optimistic. And as far as you asked about the railway spending, so as far as RailTel is concerned, there is a kitty of around 1 lakh crore, which is likely to be spent over the next 5 to 6 years. In signaling and telecom sector in railways. And RailTel is, I've been telling earlier also, RailTel is eyeing around 15% of this kitty to be executed by us certainly through tenders. We are already making strategy. Apart from this, we are also working on some future technologies. In fact, technology which is already there, but we can have a use of the same technology like digital twin and cybersecurity kind of requirement in every part of the world now. So these are another two areas where RailTel is working to get opportunities in railways, not only railways, but outside as well.
Okay.
So this is what I see about railways as far as...
Got it, sir.
As you asked.
Mr. Kumar, good morning. Prashant here. So what's the current order book at? Because you're telling us that you are hoping to win about 15,000 crores worth of the 1 lakh crore order, which you think will be put out for bidding. Over what period, sir, this is?
This will be executed over next 5 to 6 years. This is our estimate.
And this should be bid out by when? The tenders should be out by when? For this 1 lakh crore?
Tenders will be spread over a period of maybe next 1 or 2 years.
Okay.
And maybe some tenders might come later because Kavach is a new technology and Railways is also working out to make this happen with LTE technology. Presently, the Kavach which has been rolled out is on an old technology which is VHF. So the Railways is also coming out with the tenders, but I believe it will take another 5 to 6 months, maybe another 3 months also possible. But we are ready. We are working out with partners, continuously touch with the industry to take on these tenders.
And 15,000 crores is your expectation, and this will all be competitive bidding. Why the competitive bidding route?
Of course, this is competitive bidding. And we have actually started taking projects from railways through competitive biddings, and we are continuously getting, including signaling, which was hitherto not our area of experience. So now we have started taking works in signaling as well.
Okay. So a big opportunity there, 1 lakh crores in terms of just fresh bids and new orders that can come in. Sir, talk us through execution as well. It's been pretty decent for the company, and I think you're aiming at about 25% growth thereabouts for the year that's going to close out 24. But just, translating the big order wins into revenue growth, sustained, strong revenue growth, what are the kind of annual run rates that you can hope to build on in FY25, 26? Can we get faster, speedier execution of these large orders?
Yeah, certainly speed is very important when we get orders. And we have been able to execute the works, but there were delays also, I accept that. But I would say that wherever we find that there are plugs, there are gaps, we try to plug them. and we have focus actually on two things. One is delivery, and the other is receivables. So from government, receivables is another factor which affects our performance, and we are onto these two. So basically we will focus on these two things, and I'm sure that our young team will be able to do it.
So just to get the numbers, you're saying the signaling opportunity is 1 lakh crore, of which you're hopeful to win 15%. This will happen over what time horizon, the tenders?
So tenders, as I told you, I expect them to happen over next 1 to 2 years.
1 to 2 years.
Because these will be floated by individual railways. And certainly progress of the current projects will also impact the specifications and other things.
So the other opportunity is the Kavach opportunity. What is the size of the tenders over the next 12 to 24 months, and what is the market share that you're trying to garner, or you hope to garner?
See, if we talk of Kavach per se, if we take LT part along with the Kavach, so it is around 30,000 crore total opportunity size. If we talk of next maybe 2 years, So but the execution again will take time because there's a lot of infrastructure needs to be created for implementation. So that's why I'm saying that next 5 to 6 years is going to be the time frame when these projects will get executed and revenues will flow. So these are inherently not that fast projects as someone may think of.
Okay, and this 30,000 crores is part of that 1 lakh crore that you mentioned, right? Telecom and signaling, what you said.
So just very quickly, finally, on the execution piece, revenue run rate, next 1 to 2 financial years, should we expect 25% revenue growth? Can it be 30%? And you mentioned receivables from the government. What is the receivable figure as of now, and by how much do you think you can reduce that as you focus on receivables in a big way?
We say, see, government projects, there are milestone payments. So if we talk of milestone payments, we are around 600 to 650 crores as on date. And generally, we are getting payments in time. So this is what I would say about the receivables. But yeah, receivables, even 100 crore receivables delayed by 1 month, we lose on interest, we lose on cash flows. So that's why we are focusing on that part also. And when we are doing more projects, this becomes even more critical factor.
And top line growth, can you improve better than 25%?
Certainly. Okay. There's no doubt about that.
All right, so we'll leave it on that note. Thank you very much, and season's greetings. Wish you a happy new year in advance. With that, we're completely out of time on this edition of Bazaar. Many thanks for watching. Chartbusters takes the action forward.
CNBC-TV18, embarking on a quarter century of excellence. CNBC-TV18, embarking on a quarter century of excellence.
Paintmaker Kansai Nerolac zooms as the company sells the land parcel in Mumbai's Lower Parel to subsidiary of Ranwal developers for 726 crore rupees. The stock is up nearly 5%.
Cement stocks surge as brokers from Nomura expect stronger volume growth next year and issues a buy call on Ultratech, Dalmia Bharat and Ramco Cements. Also raises the price target of Shree Cements to 33,500 rupees from 27,800 per share.
L&T hits a record high as its construction arm bags an order from Saudi Arabia to the tune of anywhere between 5,000 to 10,000 crores.
Vishnu Prakash R. Punglia shares are also trading nearly 5.5% higher after the company gets a letter of award for projects worth nearly 900 crore rupees from the Uttarakhand government in what is the company's biggest order win since its listing.
And a slew of new listings continue. Today we had the listings of Credo Brands, Mufti Owner, RBZ Jewelers and Happy Forgings. All of them listed slightly flattish but have surged ever since, barring Happy Forgings, which saw a strong debut on the exchanges, listing at an 18% premium to its issue price, continues to hold higher as well.
Hello and welcome to Chartbusters. You're watching on CNBC TV18. I'm Hormus Patakia. With me is Mangalam Malu, and it's about to be a record-breaking day today. As you can see on our overhead screens, you can